this person was supposed to be knowledgeable of some of these financial strategies that were put in place by these companies. And that was stated on Section 407 of the SOX, which requires companies to disclose whether or not there is at least one financial expert on the committee. So let's proceed.
Maybe shock someone first and then.
Next.
I think they're in a cool building too, careful.
Right, so let's go to the Public Company Accounting Oversight Board. Okay, now this board was to provide insight of the public accounting corporations. It was under supervisions of the SEC, and it was responsible for establishing and adopting and modifying auditing, quality control, inspecting accounting firms, investigating potential violations of applicable rules relating to audits, imposing sanctions if those rules were violated. So the board members were to be appointed by the SEC, the Security and Exchange Commission. Next. That board had to have 5 members. 2 members had to have an accounting background. Then the 3 were allowed to have any general background. And then these public accounting firms had to be registered with that body, PCAOB. So if they were not registered to that body, it was unlawful, and therefore they could be prosecuted. This board also will have this board will also have investigative and disciplinary authority over public accounting firms. So that's it about that board. I invite back Stevie.
Yes, thank you. So moving on to auditor independence. This actually is quite important because it's one of the key values that auditing firms should have to avoid such scandals, because if they actually did work independently, that means they could not be pressurized to misrepresent facts, figures, and also not shred documents when they were being investigated. So these auditors are the ones that provide a sense of trust that the financial statements are actually fairly presented. And we're going to look at Arthur Andersen, since they're the ones who worked with Enron for about 16 years. I don't know, one would have to have been blind for 16 years not to have found those misrepresented facts. So in this act, firms that registered with the board, PCAOB board, they're prohibited from performing some certain services for an audit client, which Arthur Andersen went against. So it was okay. For instance, if an audit firm is just doing audits on a corporation, they should not take part in other activities such as bookkeeping for the corporation, appraisals, actuarial services, internal audit, outsourcing. If it's an internal audit, then it should be internal. It should not outsource audit. Other management functions, such as in the case of Tyco, where the guy was an auditor then became a CEO, that's actually conflict of interest. And other investment services. So if you do look at Arthur Andersen, it was reported that they used to make around $25 million on the audit services only, but an additional $27 million on other services that were unrelated to auditing. So that's there is just a conflict of interest. We're humans, and if money is actually waved on your face, it's kind of hard to think straight. Next slide, please.
Because if someone reports, maybe you get banned. That's why.
Okay, there was also an exception here that the public accounting firm may provide tax services to the audit client only if the service is pre-approved by the client's audit committee. That's why these firms had to have an audit committee that had to look at this and pass them or not. So yeah, all these provisions actually work together to foster good governance in the corporations. So the supervising audit partner is encouraged to rotate every 5 years to allow for the company to have a new set of fresh and skeptical eyes. Yeah, because for 16 years you can like 16 years is quite a long time, and I don't know. I think it's the same auditors who are in the firm, but yeah, ideally the firm should renew the contract for the auditors in 5 years so that they get fresh skepticism. So all of these rules are just intended to improve the auditor's independence as well as appearance. And the next slide, we're going to find a code of conduct for uh, auditors. Yeah. The last point, that's the code of conduct for auditors. And I shall read it out loud because I just placed it here for shits and giggles. I shall be straightforward and honest in all my professional and business relationships. I shall not allow bias, conflict of interest, or undue influence of others to override my professional or business judgment. I shall act diligently and in accordance with applicable technical and professional standards. So this firm and other Anderson actually went they actually broke this conduct. That's why I was saying that codes of conduct are just ink on paper if they're not actually implemented. So under the general acceptable accounting practices, the payment of a company, the payment a company receives when issuing stock only counts as equity if it is in cash. If it is in cash, that is when it is equity. But you'll find that in Enron's books, 2000 and 2001, they had overstated over 172 million and $828 million. Wow, that's a lot of money. So yeah, that's a lot of money. So yeah, so auditing is actually quite important, and if auditors don't take it to heart, that they're the ones who are uh, given the mandate to correct books and make sure that investors and all the stakeholders of the business have access to fairly presented documents, then the system is broken. So yeah, I'll invite the next presenter.
Hi, my name is Anita, and I'm going to take you through management, which is also a section that was defined in the Oxley Act to be quite crucial because if the management is not done, or rather, if it's done poorly, some financial catastrophes tend to happen, like what happened in Enron and WorldCom. So the Oxley Act requires management to take more responsibility for financial statements. Officers must personally attest that financials and disclosures are fair representations of the company's operation and financial condition. More specifically, the Act requires the principal executive officer and the principal financial officer to to certify in each annual or quarterly reports specific items. So the officer should certify that the signing officer has reviewed the report, and based on the officer's knowledge, the report does not contain any untrue statement of material fact or omit to state a material fact. And also, based on such officer's knowledge, the financial statements and other financial information included in the report fairly present in all material respects the financial condition and results of the operation. Next slide. The signing officers are also responsible for establishing and maintaining internal controls. And these internal controls ensure that material information relating to the company and its consolidated subsidiaries is made known to such officers. Then the signing officers have disclosed to the company's auditors and the audit committee all significant defiances in the design or operation of internal controls which could affect the company's report of financial data, and also any material weaknesses in internal controls. The signing officers should have indicated in the report whether or not there were significant changes in the internal controls or in other factors that could significantly affect internal controls. So, as we've seen, internal controls do sorry, internal controls promote accountability, and if they're not sorry.
We're gonna do a big hand size, okay?
Okay, internal controls promote accountability, and if they're not managed well, and if they're not followed up, you find that fraud and cases of theft have been reported. And yeah, thank you.
Let's go.
So you can move on to the next slide. I'll take you through compliance.
I don't have a pen.
So the implementation of the Sarbanes-Oxley Act did not outline how each individual company is supposed to implement its requirements, which led to companies having to consider their situations and how they may be able to meet the requirements of the act in a cost-effective manner, because there were costs, both non-monetary and also monetary. For example, some of the examples of non-monetary costs could include like managers fearing the personal liability, which makes them afraid to take risks on innovation, time of officers and time of internal auditors and time of others. You can move on to the next slide. So a survey was done by the FEI, which indicated that the average cost would be almost $2 million. 12,000 hours of internal work, 3,000 hours of external work, and auditor fees amounting up to $590,000, which means larger companies will have to spend more for the Sarbanes-Oxley Act to meet the requirements for compliance. So some beneficiaries of this act are the small accounting firms and consulting companies, as they can offer lower prices compared to the bigger accounting firms. So with independence being a concern, companies can call on smaller firms to help with certain aspects of meeting SOX compliance. This way, the external auditors not compromise independence, and companies still receive the information and assistance. So here are some of the, on to the next.
One more. Don't kill. What are you doing, man?
Hello, Timothy. You there? Seems to have disappeared. Can you hear me?
Yes.
Okay.
I'm sorry, but I'm having trouble with my connection. Maybe,
Okay.
yeah, so SOX, it also requires a formal data security policies, and it requires the companies to maintain and provide documentation for proving that they are compliant, that they're continuously monitoring and measuring SOX compliance objectives. Next, I'll go on to the next slide. So, the next slide, please. Yeah, since the method is not specified, most companies have utilized a system of certifications that utilizes various of employees with primary knowledge in the method that the companies this is the method that most companies are using to meet the compliance requirements. Under this system, employees with primary knowledge certify to the officers, as in the CEOs and CFOs, that to their knowledge, their contribution to these reports are accurate and complete. And this system, when designed and managed properly, is deemed adequate. But there's still some certain points, onto the next slide, that need to be met when using this mode of compliance. The certification process must not become a checkbox exercise, which is mindlessly completed. Those who complete the reports on financials or internal controls must keep officers' information. Officers must also not simply sign reports but are responsible for making inquiries about the reports that they're satisfying, which means they must do their due diligence and make sure that whatever is being brought to them is actually accurate. Both officers and subordinate employees must take care to keep others informed of material information and changes, so that you can have a record for accountability purposes. Companies must also form, onto the next slide, a disclosure committee, which is charged with the responsibility for considering the material.
Another lucky draw. I wonder how much you see him going to spend again this time. Anyways, enjoy the Pokemon music.
Hi, Timothy, we can't hear you. Okay, we'll just give him a minute. Not a minute, a few seconds. I believe I just take over for him until he comes back. So he was talking about the disclosure committee, which is charged with the responsibility of considering the materiality of the information and determining the disclosure obligations on a timely basis. So the members of this committee usually include the general counsel, the head of internal audit, a senior controller or financial officer. So basically an expert in finance, a financial expert, but it should not be the CFO. Yeah, and then you should also have it that the CEO and the CFO are not included in this committee, as this is all about disclosure, and it's actually like trying to see what they have been doing in their daily operations. So compliance, so the benefits of the SOX compliance. So it provides the framework that, has Timothy come back? Timothy, you come back, just say something. Yeah. So the benefits of the SOX compliance. So it provides a framework that companies need to follow to be better stewards of their financial records, which in turn improves many other aspects of the company. Yeah, and then you have that the companies, the compliant companies report their financials are more predictable, which makes stockholders happy. Because I mean, you don't want an unpredictable director with taking you guys on a wild ride whereby you have the stock prices going up and down all the time. You want there's a culture in the US whereby you should have an increase in stock prices. And if you have this, if you're predictable, then stockholders will be happy. So the companies also report that they have easier access to capital markets due to the improved financial reporting. So you can easily get into, start an IPO and make some money, raise some capital. The third one is the compliance builds a cohesive internal team and improves communication between teams involved with this audit. So the benefits of a company-wide program like SOX can have tangible effects, whereby if it mentioned that you actually have to go and talk to officers on you look at their business description, their job description, and you also look at what they've been doing. So if you have this company-wide program, you actually get people to communicate, and it actually has some value to it. So that's the acts. So I'll invite Philip. Hello, Philip, are you there?
Yes, I'm here.
Okay.
So we'll finish off with major provisions of the SOX Act. The document. One second. Just a minute.
Yeah, way back there. I'm going because I literally, this car was pointed.
Yes. The Sarbanes-Oxley Act is a complex and lengthy piece of legislation. However, three of its key provisions are commonly referred to by their section numbers, namely Section 302, Section 404, Section 802. It's important to note that because of the SOX Act of 2002, now corporate officers who knowingly falsify all financial statements can go to prison. So the Section 302 of the SOX Act of 2002 mandates that senior corporate officers personally certify in writing that a company's financial statements comply with the SEC disclosure requirements and clearly present in all material aspects the operations and financial condition of the issuer. Officers who sign off on financial statements that they know to be inaccurate are subject to criminal penalties, including prison term. Section 4.4 of the SOX Act requires that management and auditors establish internal controls and reporting methods to ensure the adequacy of those controls. Some critics of the law complain that the requirements in Section 4.4 can have a negative impact on publicly traded companies because it's often expensive to establish and maintain those necessary controls. Section 802 of the SOX Act contains three rules that affect record keeping. The first deals with destruction and falsification of records. The second strictly defines the retention period for storing records. The third rule outlines the specific business records that companies need to store, which include electronic communication. Besides the financial side of a business, for example, audit, accuracy, and control, the SOX Act also outlines requirements for information technology department regarding electronic records. It doesn't specify set of business practices, but define which company records need to be kept on file for how long. The standards specify how a business should store its records, don't specify how a business should store its records, just as the company IT department is responsible for the storage. And I think I'm done.
Okay, thank you very much. So what are the key highlights of SOX? In brief, the key highlights of the Act.
The key highlights, is it in regard to the major provisions?
If you are just asked what are the key components, key contents of the Act, how would you answer?
I'd say the main reason for the act was to prevent falsification of records. Like before the act, it was normal for the management to falsify a record and not have any repercussions. So now the act provides a safeguard against that.
So internal control, full disclosure, and what was the third one?
Auditor independence.
Bookkeeping, correct?
Yeah.
Bookkeeping. Yeah. Okay. And then now you just to put key highlights of management, compliance. What else?
Auditor independence.
Okay, independence. Auditor's independence, that's important.
The audit committee.
Audit committee, auditor's independence, subjectivity. Because objectivity also as part of it's spoken of when you speak of independence. If you are independent, you can come up with objective and reliable reports. Okay, very well. Thank you very much for that. Now, for the next class, we have a King's report and OECD. Please, you just put the important, rather key provisions. Okay, you might have to identify all the principles, but then provide some key provisions or highlight some provisions, or maybe summarize the ideas that are there. We need to finish those two next week, and if possible, to also start the approaches to corporate governance. Okay, the principle based and rule based. I think this was Vivian Moy. This is going to be Vivian Moy's group. Was to have that ready. And the other two principles. Let's try to fit these two codes in the next class. And then I hope to update your attendance by tomorrow. Now what happens with attendance, especially those ones who go on and off because of the internet? Okay, I may not be able to mark you present for the whole time, but there's an allowance there to consider whether you've done 1 hour, 2 hours, a certain number of hours at least you complete to be able to attend 2 hours, 3 hours, or 1 hour. Okay, I think that was the main message. Please, the other two groups or those three groups that I have said to be ready for the next meeting so that we can fit all the lessons that we have in the remaining days. Okay, otherwise, thank you very much. Have a good afternoon. Sorry, there was something else. Those who have not done the cut or failed to do the cut today, maybe you can just compile the list. I double check with mine. You can submit to Moses or everyone, and then he can send to me so that we can see how when you can do the cut. We can reschedule in the course of next week. And in the course of next week, probably Tuesday next week. But we shall finalize. I need to ask the administrator to help in order to have it available again. All right. So please submit your names to Moses of the ones who have sent me an email and those who are not able to do the cut. Okay. Thank you very much to the presenters and to everyone for being present. See you next week.